When you retire, your performance is more important than any other time in your life. So here we are today, it's mid-2023. Parts of the market are screaming higher. Parts of the market are not liking what they see ahead. So I want to look at different parts of the market today, both domestic and international, some growth areas, and really understand, do we have a bull market starting, or are we going to move back into another 2022? Where, if you don't remember, the market was down, S&P was down 25, and the Nasdaq was down 35%. I'm going to get to that and so much more. Stick around. Hey everybody, RC Peck here with Fearless Wealth. What I want most for people is for them to retire strong and stay retired. I like looking at price charts because even more importantly than price charts is the direction of price. That tells us a lot of what we need to know. Not our age, not the year we were born, not how we answered those 7 risk tolerance questions on that Tuesday 17 years ago, but literally what direction the market is going in. Because that's where your money is. You want to be on the bus that's heading north, not the bus that's heading south or the bus that's just driving around town. Yes, that's a metaphor, but I think you get it. So let's do this. I want to first start zoomed out, big picture. Let me get over to this symbol right here called VT. It's all world. So this is the all world. This is planet Earth stock market. Now it is priced in US dollars, so we have that. But what I want to point out to here is basically what I've been talking about for a while. We have the upside and the downside. On the upside, we have the end of 2021, right? The price peaked at the end of 2021, maybe the very first day of 2022. And the bottom is down here. The bottom is October/September of last year, which if you look at all world, not all world ex-US, but just literally all world, you can see that's the bottom. So this is the planet Earth stock market. Okay, so now let me show you everything, all world ex-US, and show you how it's looking a little bit differently. So here, this is EFA, this is all world ex-US. Now, this is what's called overhead resistance or overhead supply, meaning this is where people are hiding who want to supply the market with their shares. They want their money back when EFA gets to, $75, $76, $77, $78. So we know that. Now, international got here almost first. Another index got here first. I'll talk about it in a second, but we got here from international, all world ex-US got here first. So it makes sense that it's bouncing off that. And this was pre-COVID high, but with international or all world ex-US, this was really the range it was in. So it fell harder below the COVID peak or the pre-COVID peak. And so there was more volatility there. But mostly what I want to point out to you is all world ex-US has gotten to that point where there are sellers, where there's resistance. So you're going to see weakness for this all world ex-US, right? Just like, let me go back to just all world, and it's nowhere near up here yet, right? So there's still some more room to run. Now, this is Europe itself. This is FEZ. It is a US ticker symbol, so it's priced in dollars, but you can see Europe has already gotten to the zone. They're already in kind of that weather system of resistance. So expect some volatility if you own European stocks because they've already made it back to its, pre-2022 high. And so they're kind of hitting that resistance of sellers. So that makes sense. If we move to the US and its most highest performing index, it's the Nasdaq 100. So last year, the Nasdaq 100 fell 35%, and it actually did a triple bottom. So when most things bottomed here and started moving up, the Nasdaq went sideways for about 2.5 more months than everything else did. And so all the gains you see in the Nasdaq happen to be in this calendar year, where if you look at international or SPY or almost anything else, all their gains started here, and you probably have about a third of their gains in last year. But what I want to point out to you here is the overhead resistance for the Nasdaq 100. And it looks like the Qs of the Nasdaq 100, they want to get back up to that resistance too and just check to see, hey, are there sellers? And by the way, there will absolutely be sellers. So the Nasdaq is screaming higher, as is everything else, but all of its screaming higher has happened in this calendar year. So it's kind of I don't want to call it a calendar trick, but it just happens to have fallen all in this calendar year and not with, some of it last year and some of it this year. But that is the Qs, or the Nasdaq 100, which is the 100 largest non-financial stocks in the Nasdaq composite. Okay, as I zoom in, now I'm just looking at tech itself, right? So no, QQQ is not all tech, but XLK is all tech. And what I wanted to point out is it's already there to its overhead resistance, its overhead supply. So it's in that right now. And so we're going to watch and we're going to see more volatility come in with tech, because this is where, the sellers are hiding, or this is where the supply of these shares are going to be for the holders of technology around the world to start supplying back, like, okay, yeah, I want to get some of my money back. Now, as we zoom into XLK, one of the leading subsectors, there's a handful of them that are also doing strong, but I want to just look at semiconductors. Software is also doing really well, but this is SMH right here, which is semiconductors. Now, unlike the Qs, actually, let me look at XLK. XLK also bottomed in October of last year, did not have a triple bottom like the Qs did. You can see it moved higher through the end of last year. Here's SMH, it bottomed here. Now, if you watch any of my videos, you know that almost everything bottomed in October of last year because the dollar peaked. So SMH has been on a tear. Now, in 2022, SMH was a very painful thing to own. It fell 45%. That's pretty big. It only took about 9 months to lose 45% of it. But since then, it has absolutely been hauling. What I want to point out to you on this video is it's up there, right back to its upside resistance, right, where all that supply is. So you have Europe right up there. You have all world ex-US, which most people in the US would just call international. It's right back up to that overhead supply. XLK technology is back up to that overhead supply. Semis are back up to their overhead supply. And so I think what we're doing is we're probably coming into volatility. Now I show these videos. I am dyslexic. I think in pictures. I like seeing a picture. It tells me what's going on. Understanding price directions is what's most important for retirement, not your age or how you answer those risk tolerance questions. That has to do more with income, which has less to do with the market and more to do with financial planning, or all to do with financial planning. Financial planning is absolutely important. So is estate planning and all other types of planning. But the thing that's more important than anything else is performance, right? If you can solve the problem of performance, you can solve, 100 other problems, or those 1,000 other problems kind of solve themselves. So a lot of this is really focusing on what's the one problem that can solve the other problems, and it's portfolio performance. So you have SMH, you have semis up here with its overhead resistance. And then finally, the stock that's been in the news is Nvidia. Now, Nvidia broke through its overhead resistance here, and it did it last week in a very loud and boisterous way, right? It absolutely popped through. It actually gapped above. So is Nvidia going to pull the market higher? Like, are they the front end of the sword, the tip of the sword that's then going to bring semis through, and then tech through, and then Qs through, and then the spiders through, and is Europe going to pull it through? So we're in this place where it's, do we move higher? And the bull market does not start until we break out to new lifetime highs. So there's a new bull market in Nvidia, but not in semis, not in tech, not in the Qs, not in Europe yet. You have to be at new lifetime highs. Now, I will say this to you, France and Germany are breaking out to new lifetime highs. So that's a good sign. That's a sign of strength and stability. So there is upside resistance. And what we really want to see is the market breaking above where all that supply is. And once it breaks above that and stays above, that's where things can really start to take off, and you get that longer term trending. But like I say, there's a lot of upside resistance going on. Okay, so what are the takeaways? Look, technology and the big 10 stocks are doing really, really well. The new the new thing, whether it's the invention of electricity. Some people are thinking that AI is like electricity or the phone, and other people saying, no, it's more like the iPhone or the web browser or social networks like Facebook. First of all, whichever one it is, it's a big deal and it's not going away and it's changing a lot of things. And it's clear, watch last week's video that I talk about the best AI ETF is actually semiconductors and software companies, because they're going to figure it out more than anything. Specifically, cybersecurity software companies, they're going to be using AI a lot. So it's not a company that necessarily has the two letters AI in it, but it's the companies that really implement that. So the market has overhead resistance. We're getting closer to it. If you own Europe or your money's international or all world ex-US, you're up into that kind of resistance area. Tech is already up there. Semis are already up there. The Qs are getting up there. S&P is getting up there. So expect some volatility. And if the market does break through that, that is a good sign for the next, I would say for at least the next, I think about what this is, the next 18 months. And yes, there is a lot of bad news on the horizon. There are inverted yield curves. And that helps us understand where we are. But the recession or a downturn, that can happen 10 months from now, 20 months from now. It's not a timing mechanism. It's more of it's more like weather than climate, or it's more like climate than weather. Like climate's more kind of a macro, where weather is more acute. I hope that made sense. Anyway, thank you for being in my world. Leave a comment. It makes a difference. Like, subscribe. I hope your weekend is going well. Thank you for being in my world. And let me know where you think I got it right or wrong. All right, take care.